Hi, I'm Tom Lydon with ETF Trends here in Chicago at the Morningstar Investment Conference. Here with Paul Kim, Managing Director, ETF Strategy, the principal. Great seeing you, Paul.
Great seeing you again, Tom. Thanks for hosting.
Well, there are a lot of people looking at fixed income. We're in a time of rising rates. Obviously, that has some negative effects on the fixed income markets. Let's talk about active fixed income and why that's really important for ETF investors today.
I think the timing for active is it's a great opportunity. Basically, late in the cycle, you're going to have winners and losers. So now is exactly the time when you want that expertise, that credit research, demonstrated investment process. And fortunately, we are happy to say we have 3 active fixed income strategies right now. YLD is a multi-asset income strategy. Think of it as a better high yield alternative, a way to get about 5% income, but going where the opportunities are in all asset classes. We also have an investment grade corporate active ETF we just launched recently on the NYSE. And yes, it's got duration, but fortunately with the way, again, active credit research, you get to pick sort of the business models that do better in a rising rate environment, business models that do better where the yield curve is starting to move. And so I think that's an opportunity. We also offer an exposure to preferreds. $1,000 preferreds have a lot of embedded sort of protections against rising rates, better duration exposure or lower duration than $25 pars. And so that ticker, PREF, all 3 are a way to access income, which isn't going away. The need for income is only going to grow more important, but being able to navigate the changes and the opportunities is crucial.
It is, and some of the things you're talking about, preferreds, corporates, high yields, historically actually do well in rising rate environments while the economy's good. What suffers are treasuries, especially long treasuries. And my biggest fear is the average advisor who's embracing the Barclays Ag and the huge allocation that's in treasuries is detrimental to the client portfolio.
Yeah, ironically, the safest part of the fixed income market from a credit quality perspective is just full of danger, right? That is literally just pure duration exposure. If you could find a way to get better exposure, safer duration, softer duration as they call it in fixed income, take advantage of credit spreads, take advantage of mortgages, take advantage of, again, picking businesses that can navigate rising rates. Yeah. And we really think active management, active ETFs offer a lot more choice today than we had 10 years ago. So I would say investors owe it to themselves and their clients to take a look. Don't just rely on the traditional 60-40. The Barclays Ag or the Bloomberg Ag now is got a lot more sort of downside to it than people may realize, and it may not offer sort of that counterbalance to market risk anymore.
And traditional indexes in corporates and high yields tend to be more cap weighted, and it doesn't always mean that those constituents actually are in good shape as well. So you're saying research is going to be that much more important.
Research is important. Think about the high yield ETFs out there. You're a market taker, so if a big investment grade issue is downgraded and drops into the index, you're buying it. And compare that to, again, an active manager who could be much more discerning about opportunities, again, picking the winners versus the losers and not being market takers, but being someone who's much more opportunistic.
Yeah, absolutely. Well, what you're talking about is what's key and critical now, and I think advisors are getting it, but they got to act because this rising rate thing is not going away anytime soon. Yeah. Great seeing you, Paul.
Great. Thanks, Tom.
Thank you.